This week, what I'm covering is forward versus futures contracts, right? Now, why did I choose this topic? Well, one, in recent times, you've been seeing Bitcoin start to edge further up and those things and start doing this climb. It's partly because they released a Bitcoin ETF, right? And ETF is essentially like a mutual fund, but it's actively traded on the stock market. So that's usually almost anything that you could find a mutual fund on, you have an ETF on, right? It's just that ETFs aren't as managed as a mutual fund, right? So it still works out better to be in a mutual fund, but an ETF, if you can't afford the upfront of the 2,500 that a lot of them ask to get in for a mutual fund, you can go ahead and go into an ETF, right? So with the Bitcoin ETF, there was a lot of buzz around that. Well, the thing with that is it is a futures contract for the Bitcoin, right? It's not a standard, oh, they go ahead and they're just buying all this Bitcoin right now and all of that. It's a futures contract ETF. That was essentially their only way how they could get around the SEC. The SEC has essentially been blocking any form of crypto to hit mainstream Wall Street. And I think they've shut down about 4 or 5 attempts previously. And so now they kind of found this loophole that says, hey, how about we do it as a futures contract? And the SEC said, okay. And so now we now have a form of Bitcoin on the stock market, right? The other reason why I want to cover it is especially with rising gas prices. Everyone is saying, but I see that oil went down. Why is gas price still so high? I see that the Jamaican dollar went down. Why is JPS still charging so high and those things? Well, a lot of those have to deal with forward contracts, right? And so that's why I wanted to at least cover the basis of futures and forwards, right? So as I said, guys, we're doing a new format this week. If you guys have any questions throughout the presentation or any questions at all, go ahead and just send me a private message. And once the presentation is finished, I will see how best I can address them, right? So, all right. As an individual, what do they mean to me, right? Because you hear futures contract, futures and forward contracts, like what do they mean to us? Well, companies use it as hedges, right? To make their prices more stable. If the company's prices are more stable and more predictable, then the cost that comes down to us as the consumer is more stable and more predictable. That is why they're able to say a week in advance, hey, your light bill is going to go up. Hey, gas prices is going to go up. They're able to tell you this at specific intervals because they're not essentially at the will of the market of the next day or at that hour, right? So that's one thing. It adds stability not only to the companies, but to us. Whether or not we like it, but it's better to know that, okay, this is what my light bill is going to cost than your light bill is going all over the place every 2 seconds, right? The other thing is, so the areas that are most volatile, currency, agriculture, commodities, they use it to try and hedge against those. What's another thing? Well, if you look at any of the US stock markets, especially before the market actually opens, the US stock market opens at 9:30 New York time, which is 8:30 in Jamaica. if you're watching it at 9 o'clock, all they're talking about is, oh, the S&P futures, the Dow futures, the NASDAQ futures. And all they're talking about is all these futures and saying, oh, the futures are up or the futures are down. Why is that? Well, futures give a gauge as to how the stock market is going to perform when the markets actually open at 9:30. So if futures are way up, they anticipate that when the market opens, it's going to be a good day overall. I mean, your individual stock might fall, but overall, for the indexes, they would go up, right? So futures are a predictive measure to the day's market movement. All right, so we hear about forwards and futures. Now, what is it that they have in common, right? Well, both of them, right? And both of them have the same basic definition, right? And that is they both are agreements to purchase or sell something at a specific price at a specific time in the future, right? Both of them have that same underlying definition, right? Their differences is how the execution of that contract is done, but the underlying definition is the same. So a forward contract or a futures contract is just saying, I am going to buy this, I'm going to sell this for this price at this date in the future, right? And I'm sure you guys have heard me use the term before where I would say long and short, right? It really comes from futures and forwards terminology, right? A lot of times we'll take right? A lot of times people take terminologies from various aspects of the investing world and just kind of put it as just common knowledge, right? But here's where it really comes from, right? If you are a buyer, right? So you are buying, you're buying a commodity, you're buying oil, you're buying something at a specific price in the future, you are doing a long position. So you are considered long, right? If you are a seller selling a product at a specific time, at a specific price in the future, you are considered a short. So when people will say, oh, that person is trying to short the market, it means that he's predicting that at a specific time in the future, the market will go down, right? You will hear people say, oh, I'm going long on Bitcoin. That means that they're buying, they're predicting that Bitcoin will reach a certain price at a certain time in the future, right? So that's where the long and short come about. So how do they make money, right? Well, remember, you are buying and selling at a price in the future, right? And so this is kind of almost like a chess game, right? You are trying to predict what is going to be the next move of that underlying asset, right? So by people who are going long and people who are going short have opposite views on how it's going to go, right? So for instance, some people right now are going short on Bitcoin, right? Because they're anticipating that it's going to go down in the future. Some people are going long on Bitcoin that's saying that it's going to go up in the future. Now, when you go ahead and enter into either a futures contract or a forward contract, you're locking in that price, and your gain or your loss is going to be the difference between the price that you locked in and the actual value of the underlying asset. So you go long on Bitcoin, right? Well, you say, I want to buy Bitcoin at, let's say, 67,000 by December, and Bitcoin is valued at 70,000 in December. You are paying 60,000. That's what you're paying. And you're getting an asset that is worth 70. So you have a 10,000 gain from that. So that is how they get money, right? Inversely, with the short, remember that's the person who is selling, right? They want it to go down, right? So they want you to lock in Bitcoin. I said 10, right? So let's use 60, right? So they want you to lock in Bitcoin at 60,000 by December. Now in December, they're hoping that Bitcoin will be worth 50,000. And so then it is now a 10,000 gain to the short, right? So that's all it is. If the price goes up, the long makes money. If the price goes down, the short makes money, right? So what are the differences between future contracts and forward contracts? Because we already said that both of them have the same underlying premise. You are buying or selling something at a specific price at a specific time in the future, right? So what are the differences? Well, forward contracts, and this is why you'll hear the term futures more than forwards. A forward contract is a contract between two parties, right? So you want to go ahead and lock in a price of an item with a seller. You are going to engage into a contract with that seller. It is between you and that seller, nobody else, right? The other thing, it's not regulated, right? It is between you and the seller. There is no government is not looking in on it. There's no regulatory body to ensure that everything works out. It's strictly an agreement between you and the seller, right? Now, because of that, the risk of default is really high. If at the time of execution, one party doesn't have what they're supposed to bring to the table, whether it's money, whether it's an actual product, if they don't have it and they don't produce, there is really nothing you can do. That entire contract has just fallen apart, right? So if you went ahead and you held on to, let us say you're selling jewelry, right? Yeah, let's say you're selling jewelry and you lock in the price. Now, if at that time you're ready to produce the jewelry and that person say, oh, you know, I can't bother. You've been holding on to this jewelry that you could have let go before, but because you had this agreement with this person, you held on to this jewelry for this amount of time, and then this other person decides they're not going to go by their end of the bargain, right? So that is a risk that forward contracts have. Another difference between forward contracts and future contracts is that forward contracts are not, once again, it goes back because it's just two parties. So they're not actively traded on the stock market, right? Because it's just two parties. They're sitting down in the back room, coming up with their deal. This is how it's going to work. This is how much I'm going to pay. This is when I am going to be ready for it, right? Now, futures, right? Futures reduces the risk of default because they use a medium, and that is called the clearinghouse. What the clearinghouse is rather than one seller dealing with one buyer doing a contract, what will happen is that you'll have multiple sellers essentially putting out their bids, saying, I am willing to sell for this, I'm willing to sell for this, I'm willing to sell for this, I'm willing to sell for this. At their specific times. Okay, by June 30th, I'll sell it for this. By December 25th, I will sell it for this. They put that towards the clearinghouse. Then on the other end, you have a bunch of buyers that are saying, I am looking to buy this product at this price on this date, right? And the clearinghouse essentially just matches buyers and sellers, and that's it. So buyers and sellers don't even know each other, right? When you're in the futures market, you don't know, when you get the product, you don't know who actually sold you the product, right? There's no actual in face-to-face interaction, email to email, however type intimate interaction that you would get with a forward contract, right? The other thing is, so with the clearinghouse, they match buyers and sellers. The other thing the clearinghouse does is that they essentially guarantee that the execution of the contract will happen, right? How is that? They've essentially already, in theory, bought the items from the seller, right? So the seller is going to get their money, and they already have the item to give to the buyer. So the buyer is going to get that item, right? To give an example of when this goes wrong, right? In one of the financial meltdowns, I believe it was the one of 2008, when the barrel of oil actually went into negative amounts. So many people had bought these barrels, right? That when it came time to execute, mind you, if you buy a futures contract, right? No, you had so many sellers, but not enough buyers, right? So what happened was the clearinghouse had to honor what the sellers were putting up, right? But they're putting up these barrels of oil in negative amounts. So there wasn't many buyers. So all of a sudden, Wall Street was inundated with all these barrels of oil, and they had nowhere to put it. So they literally had to rent cargo ships in order to store these barrels of oil out at sea, which is crazy, right? I don't know why that didn't hit more mainstream media, but that was crazy, right? So that's when it goes awry. But that's the clearinghouse, right? Now, so the clearinghouse goes ahead and guarantees, so it reduces the risk of default. The clearinghouse matches buyers and sellers, right? The other thing the clearinghouse will do, which is different with futures and forward contracts. With a forward contract, when you enter into the forward contract, you do not need to pay anything upfront. Your payment is due upon execution of the contract, which is in the future. You don't need to do anything now apart from agree to the terms of the contract. Futures, however, does a margin, right? And what they're essentially saying is you are looking to purchase this much oil in the future, right? We will put up the money, but what we're going to do is we're going to require you to make a payment today of a fraction of what we're going to put up, almost like a good faith type thing, right? And you go ahead and put it up, and they call that the margin requirement. So they essentially say, if you don't have enough money today in order to put up the margin requirement, then you can't enter into that contract, right? Now, if, let's say, the oil goes down and you were set to buy and looking for a profit, the price that you locked in, but the oil is now much lower. They now have to pay the seller that gain, right? You think that the clearinghouse is going to be eating all of that money? No, the clearinghouse just made a loss. What you are going to see is that you're going to see your account dip down. right? They're going to take that money from you, right? Whatever was the loss, they're going to take that loss from you. Now, if that loss is below your required margin, so let's say you have a required margin of $30. If your account goes below $30, they're going to say you cannot do anything until you've at least put it back up to $30, right? So if you ever hear anybody, and I know you hear me with it, with margins, that's what margins is, right? Margins is essentially allowing you to enter into futures contract through a clearinghouse. And who do we call the clearinghouse? Like these FX brokers, right? So when people are going, you realize what I'm getting at here. Forex trading is entering into futures contracts, right? So if you're doing a Forex trade, or if you're doing any form of trading and you're going through one of these brokerage like forex.com, ig.com, or any of those, they're essentially a clearing house, right? You go ahead and say, I am going long on the Canadian dollar, and you are putting up X amount. Well, you're not putting up the value of how much Canadian you actually are anticipating to go up. The clearinghouse will put up the rest. But what you will see come out of your account, you will see that a portion of your account is now put on hold, and it's called margin requirement, right? So they may say that in order to enter into this trade, you need at least a margin requirement of $30. So when you enter into the trade, you'll see $30 put on hold. That's what the clearinghouse is holding until it's executed. Once it's executed, especially if you come up with a profit, you'll get back your 30, they'll release the 30, and then whatever was the gain, right? Whatever was the gain. So if it was going up and you executed it at, let's say, $1,000, and it went up to $2,000. So that's $1,000 profit. You're not getting $3,000 into your thing, right? What you're going to get is the $1,000 profit and your $30 margin. So you're going to see 1,030 come back into your account. So that's how clearinghouses work. Now, the last thing about futures contracts is that futures contracts are actively traded on the stock market, right? This is why you always see these analysts say, oh, we're watching the futures, let's see what the futures going and so forth. Because unlike a forward contract that is between you and one other person, a futures contract is just matching buyers and sellers, right? And so because of that, nobody is really tied to anybody, which means that people can come out and people can go in a lot more freely. And the reason why Forex, I'm here thinking of Forex. The reason why futures are a gauge for the stock market is because they're watching the participation and what the participation is doing. So let us say a majority of people are going into the futures market on short positions. That means there's a lot of people out there that is essentially seeing the market going down, right? And so if you're looking for a gauge, you look at that and they say futures are down, that means chances are the stock market could be down for that day. Likewise, if they see a lot of participants coming in and they're going into long positions, that means they're buying. That means it could be a very good day for the stock market, right? So that's why they go ahead and talk about futures and all that. Before and after the stock market opens and closes, all right? I know that was kind of long-winded. All right, so to sum up, forwards and futures are hedges against volatile assets, right? Agriculture assets, precious metals. They fall under commodities like lumber and all those things. Oil, right? Those are all things that are volatile. And so companies, in order to predict their costs, which in turn makes our bills more predictable, do use forwards and futures to hedge against the shocks, right? Futures are a gauge of the sentiment in the market. If futures are up for the day, the sentiment is that it is going to be an up day for the market. There's going to be more buyers in the market than sellers for that day. They both help companies predict cash flow. As I say, if it's predictable, right, then they can kind of get an idea how to manage their money, right? And as investors, it is important that the companies that we invest in, if they're dealing with these volatile commodities, they manage their cash flows accordingly, right? Because weak cash flows, weak operations, can't meet mandatory obligations, can't pay out dividends, all those things. So you want them to manage their cash flows properly. And it's usually the reason why we see these delays, why when you look and you see oil price shoot up this week, you go to the gas station tomorrow and gas hasn't risen yet. But next week they'll say, oh, prices will go up at the pump. And you're like, oh yeah, because last week oil went up. So when they went ahead and entered into new contracts, it was at a higher price. That is why, even though the currency right now is at, I believe, 155, I was at FGB today and it was at 157, right? Now, if you look at your JPS bill and see what rate they're converting it, chances are it's not at the 157. But if it stays at the 157 long enough, that's when you'll hear JPS come out and say, oh, your energy bills are about to go up. Yep, new contract, right? And the new contract is locking in at a higher rate, right? So that is it for my presentation today, guys. As I said, I did want to talk about a little bit of the current events. So we'll talk about that after the recording. And be sure to check out the videos that I'm putting up each Sunday. It's usually these videos, but you're able to like, you're able to comment, and I will reply to as many comments as I can. All right.